3 months after launch, your bank account shows $2,847. You've completed 47 trips. Your insurance payment is due in 6 days. Your driver just quit, and you're staring at a Medicaid reimbursement check that won't arrive for another 53 days. This is the exact moment 70% of NEMT startups realize they didn't plan for cash flow gaps. And it's the exact moment most businesses die. The NEMT market is growing toward $13.93 billion by 2030. But that growth doesn't save operators who run out of money before their first broker check arrives. Because the companies that fail aren't losing to competition. By the end of this video, you'll know exactly why most NEMT businesses collapse in their first 12 months, and how to avoid every single failure point. We're not talking theory, we're talking about the documented reasons operators with good intentions. So let's break down why the 90% fail and how the 10% survive. Failure point number 1, the cash flow death spiral. The number one killer of NEMT businesses isn't lack of demand. It's running out of money before reimbursements arrive. And this isn't speculation because 82% of business failures are due to poor cash flow management. Actually, in reality, you complete a trip in January. You submit the claim to your broker within 30 days. The broker reviews your claim for another 15 to 30 days. Then, Medicaid processes payment in 30 to 60 days. You receive reimbursement 30 to 90 days after the actual trip. That's 60 to 120 days between providing service and getting paid. But your expenses don't wait. Your driver needs payment every 2 weeks. Your insurance company wants their monthly premium. Your fuel bill is due immediately. Your vehicle payment can't be delayed. So you're spending $8,000 to $12,000 monthly while waiting for checks that won't arrive until month 3 or 4. That's why operators with successful trips and growing demand still collapse at month 4. The math was wrong from day 1. Failure point number 2, broker contracts you can't actually fulfill. Next failure point is, getting broker contracts feels like winning, but fulfilling broker contracts is where most operators fail. Because brokers don't just want transportation, they want proof of network capacity, compliance documentation, and real-time trip tracking that most startups can't provide. The broker application process requires proof that you can handle trip volume during peak hours. If you're starting with 1 vehicle and 1 driver, your network capacity is minimal. Brokers need providers who can scale. So they're looking for documented growth timelines, showing vehicle additions and driver hires over the next 6 months. But there's a bigger problem. Once you get the contract, brokers have strict performance requirements. They track on-time pickup rates, missed appointment percentages, customer complaint ratios, and documentation accuracy. Fall below their thresholds, and they suspend your contract immediately. Failure point number 3, Medicaid billing rejections that destroy revenue. Moving to other, you can complete 100 perfect trips, but if your billing documentation has 1 missing signature, 1 incorrect service code, or 1 eligibility verification error, the claim gets rejected. And claim denial rates in the NEMT industry commonly reach 10% to 20%. Which means 10 to 20 trips out of every 100 generate 0 revenue. The documentation mistakes that kill cash flow are missing patient signatures, which result in instant rejection, incorrect service dates or times, wrong patient identification numbers, unauthorized trip submissions where the patient wasn't pre-approved by the broker, and mileage disputes when your odometer documentation doesn't match broker expectations. Actually, every rejected claim creates a compounding problem. First, you lose the immediate revenue. Second, you spend administrative time identifying the error. Third, you must correct and resubmit the claim. Fourth, the resubmission resets the payment timeline, adding another 30 to 60 days to your cash flow gap. By the time you correct 5 rejected claims, you've added $3,000 to $5,000 in lost revenue and 45 to 90 additional days to your receivables timeline. Before we continue, NEMT operators who survive understand that staying informed isn't optional. Medicaid rate changes, broker policy updates, compliance requirement shifts. If you miss one update, you can lose an entire revenue stream. Join the Nemiton for the weekly breakdown that keeps you ahead of industry changes. Link is in the description. Failure point number 4, driver turnover that destroys operational stability. Failure number 4 is something simple but holds a deeper meaning. Your business runs on drivers, but driver turnover in NEMT exceeds 64% annually in several US markets. That means if you hire 3 drivers in January, statistically 2 of them won't be working for you by December. And every driver who quits costs you $3,000 to $5,000 in recruiting, background checks, training, certification, and lost productivity while you're understaffed. If you're experiencing 60% annual turnover with a 5-driver operation, you're spending $9,000 to $15,000 annually just replacing people who leave. But the real damage is operational chaos. When a driver quits with 2 days' notice, you can't cover their scheduled trips. Missed trips generate customer complaints, which brokers track. 3 complaint incidents and brokers start questioning your reliability. 5 incidents and they're evaluating contract termination. So driver turnover doesn't just cost money, it actively destroys the broker relationships that generate your revenue. The operators who survive treat driver retention like the business priority it is. They offer consistent schedules instead of erratic on-call shifts. They pay performance bonuses for 0 complaints and 95% plus on-time ratings. And they provide basic respect and professional treatment, which apparently is revolutionary in an industry known for treating drivers as disposable. Failure point number 5, insurance costs that exceed profit margins. Commercial NEMT insurance ranges from $2,000 to $12,000 annually per vehicle. For most startups, insurance becomes the second largest fixed expense after vehicles. And if you're in an urban market where rates hit $3,500 to $7,500 per vehicle annually, your insurance costs can easily exceed your first-year profit margins. So let's run the math. 3-vehicle operation in a suburban market at $4,500 annual premium per vehicle equals $13,500 in annual insurance costs. That's $1,125 monthly before your first trip. If your average Medicaid reimbursement per trip is $35, and you're completing 15 trips daily across 3 vehicles, you're generating $15,750 monthly in gross revenue. Subtract $1,125 for insurance, $4,500 for driver wages, $2,100 for fuel and maintenance, $600 for software, and $900 for vehicle payments. You're left with $6,525 monthly before considering licensing renewals, emergency repairs, or the owner's salary. That margin disappears the moment you face an unexpected expense. 1 vehicle breakdown requiring $2,800 in repairs consumes 43% of your monthly margin. 2 drivers call in sick during peak hours, and you miss 12 trips worth $420 in revenue. Your profit just dropped to $3,305 for the month. And remember, you haven't paid yourself yet. Failure point number 6. Vehicle decisions that multiply maintenance costs. Buying the wrong vehicle doesn't just waste capital. It creates a maintenance expense cycle that drains cash flow for the entire life of the business. The mistake most operators make is buying vehicles older than 10 years to minimize upfront costs. A 2012 Ford Transit wheelchair van might cost $18,000 to $25,000, which seems financially responsible compared to a $35,000 newer model. But that 2012 vehicle is now 13 years old, which means increased breakdowns, higher maintenance frequency, and potential broker rejections due to vehicle age policies. Actually, the optimal vehicle age is 5 to 10 years old. A 2018 Ford Transit in good condition costs $35,000 to $45,000, but provides reliable service with minimal maintenance for the next 5 to 7 years. Spend an extra $15,000 up front and save $4,000 to $7,000 annually in reduced maintenance and breakdown-related lost revenue. And there's another vehicle mistake that kills operators: over-customization. You don't need luxury interiors, premium sound systems, or custom paint jobs. Brokers pay per trip based on medical necessity, not vehicle aesthetics. Every dollar spent on non-essential customization is a dollar that could have covered 3 months of insurance or 6 driver paychecks. Failure point number 7, operating without adequate cash reserves. Most business advice does maintain 3 to 6 months of operating expenses in cash reserves. For NEMT, that's not a recommendation. It's survival math. Your operating expenses include driver wages, insurance premiums, fuel costs, vehicle payments, software subscriptions, and facility costs. For a modest 3-vehicle operation, monthly operating expenses range from $10,000 to $15,000. 3 months of reserves means $30,000 to $45,000 in liquid cash sitting in your business account before you transport your first passenger. Most operators launch with $8,000 to $15,000 in reserves, thinking they'll generate enough revenue to stay ahead of expenses. That works if everything goes perfectly, but in NEMT, nothing goes perfectly. Medicaid reimbursements take longer than projected. Broker contracts experience unexpected delays. A vehicle needs emergency repairs. 2 drivers quit within the same week. Insurance premiums increase at renewal. Without adequate reserves, the first unexpected expense creates a crisis. You can't make payroll without pulling from next month's insurance payment. You can't pay insurance without delaying vehicle repairs. You can't maintain vehicles without compromising driver retention. The death spiral begins, and without cash to break the cycle, the business collapses. Failure point number 8. Technology gaps that prevent broker integration. Modern brokers require technology integration that most startups don't have. They want real-time trip tracking, automated status updates, electronic claim submission, and GPS verification of pickup and drop-off times. Operators running manual dispatch with basic scheduling software don't meet these requirements. Brokers like ModivCare, MTM, and VO require direct API connections for trip assignments and automated data exchange. If your software can't integrate with their systems, you're manually entering trip details, which creates delays, increases errors, and positions you as a low-priority provider when brokers assign high-volume contracts. The technology that separates surviving operators from failing ones is NEMT software, with broker integration, GPS fleet tracking, automated billing and claims management, and real-time driver-passenger communication. Basic software starts at $200 to $400 monthly. Comprehensive broker-integrated systems run $800 to $1,500 monthly. That's $9,600 to $18,000 annually for top-tier software. Most startups see that cost and choose the $200 monthly basic option to save money. Then they spend the next year manually processing claims, losing trips to missed communications, and getting deprioritized by brokers who prefer providers with automated systems. The $12,000 saved on software becomes $40,000 lost in operational inefficiencies and missed broker opportunities. Failure point number 9. Compliance violations that terminate contracts. NEMT operates in a heavily regulated environment. One compliance violation can suspend your broker contracts, revoke your Medicaid enrollment, or trigger state audits that consume months of operational capacity. The compliance requirements that catch most operators are driver qualification files missing required documentation. FMCSA regulations require specific documents for every driver, and missing one document during a broker audit results in immediate contract suspension until you achieve compliance. Vehicle inspection records not maintained on proper schedules. Brokers require proof of 30-day DOT-compliant inspections. Miss 2 consecutive inspection deadlines, and you're facing contract review. Eligibility verification failures where you transport patients who aren't pre-authorized. 1 unauthorized trip won't kill your business. 5 unauthorized trips in 2 months suggest systemic compliance failures, and brokers start termination proceedings. Fail point number 10. Pricing strategy that ignores real costs. Medicaid fee schedules are non-negotiable, but operators still fail by not understanding the actual cost per trip, which determines whether they're profitable or slowly dying. Each state publishes Medicaid NEMT reimbursement rates. Louisiana pays $16 base rate plus $1.50 to $2.25 per mile. Arizona pays 56 cents per mile for ambulatory transport. California averages $2 to $3.50 per loaded mile. Those are your revenue numbers. Now calculate your actual cost per trip. Driver wage for trip duration, fuel cost based on distance, vehicle depreciation allocated per mile, insurance cost per vehicle per day, software cost per trip processed, maintenance reserve per mile driven, administrative overhead allocated per completed trip. For most operators, the actual cost per trip ranges from $28 to $47, depending on distance and vehicle type. If your average Medicaid reimbursement is $35 per trip and your actual cost is $42, you're losing $7 per trip. Complete 500 trips monthly and you're losing $3,500 while thinking you're running a successful business. The only solution is understanding your real numbers and supplementing Medicaid trips with private pay clients where you set rates at $50 to $150 per trip. One private pay contract generating 40 monthly trips at $75 per trip adds $3,000 in revenue that actually covers your margin gaps. Look, 1 in 5 small businesses fail within their first year, and NEMT has additional challenges that push that number even higher. But the businesses that fail aren't losing to bad luck. They're losing to predictable cash flow mismanagement, inadequate planning, and operational decisions that prioritize saving money over building sustainable systems. If you found this valuable, subscribe to Nemiton. We're the only media company building content specifically for NEMT operators who want to survive and scale.